The numbers don't lie, but they do whisper before they scream. In February 2025, the State Administration of Foreign Exchange released data that should have stopped the financial world in its tracks. China experienced a record $168 billion net outflow of foreign direct investment in 2024, the largest capital flight since records began in 1990. This wasn't a decline or a slowdown, this was capital running for the exits. But here's what nobody's telling you. This $168 billion exodus represents just the opening act of a $200 billion transformation that's quietly reshaping the entire architecture of global manufacturing. While economists debate tariff percentages and trade negotiators posture about market access, the world's factory floor is being dismantled and reassembled in real time, and the consequences will define the next decade of economic power. Throughout history, manufacturing dominance has never been permanent. The British textile mills that powered the Industrial Revolution eventually gave way to American factories. Those American factories later migrated to Japan, then to Korea, and finally to China. What changes is never arbitrary. It follows a predictable pattern that economists call the industrial life cycle. This cycle unfolds in 4 distinct phases. First comes the attraction phase. Low costs, favorable policies, and hungry labor forces draw capital like gravity pulls water downhill. Second arrives the golden age. Infrastructure improves, supply chains deepen, and the entire ecosystem reaches peak efficiency. Third emerges the maturity trap. Costs rise, regulations tighten, and the very success that attracted capital becomes the weight that drags it down. And finally comes the exodus. Capital doesn't trickle out. It floods toward the next frontier, leaving behind infrastructure that once hummed with productivity. China is entering phase 4. The data from November 2024 reveals that 69% of companies surveyed by Bain & Company are actively moving operations out of China, compared to just 55% in 2022. This isn't speculation, this is a 25% acceleration in corporate exodus in just 2 years. When 7 out of 10 global manufacturers are simultaneously heading for the door, you're not witnessing a trend. You're watching a structural collapse in slow motion. Let's examine what happened in 2024 with surgical precision. China's actual utilized foreign direct investment plummeted 27.1% year over year, falling to approximately $116 billion, according to Ministry of Commerce data. But the real shock came in the balance of payments data. For the first time since modern records began, China's net FDI position turned negative in the first half of 2024, registering at negative $4.6 billion. Think about that. More capital left China than entered it, marking a fundamental reversal of a 40-year trend. The sectoral breakdown reveals where the hemorrhaging is most severe. China's industrial profits dropped 13.1% in November 2024 alone, the steepest monthly decline in 14 months, according to Reuters, reporting on National Bureau of Statistics data. Manufacturing profit margins have been crushed by what Chinese authorities delicately call insufficient effective demand, which translates to nobody is buying what they are making. State-owned enterprises recorded deep losses throughout 2024. While even the high-tech manufacturing sector that China desperately needs to lead its economic future saw significant profit declines through the first 10 months of 2025. Consider the companies leading the exodus. Microsoft announced in October 2024 that it was shifting the majority of its hardware production, including Surface laptops and data center servers, out of China. Nike, Intel, and Dell have all signaled major manufacturing relocations. Apple, despite maintaining significant iPhone production in China, closed its Dalian retail store in August 2024, the first Apple store closure in China in the company's history there. These aren't minor adjustments. These are strategic retreats by the world. As most sophisticated supply chain operators, the geographic reallocation reveals the new power centers. Vietnam has become the immediate beneficiary, particularly in northern provinces like Bac Ninh, where Chinese manufacturers are literally reconstructing their Chinese factories on Vietnamese soil. Mexico experienced unprecedented nearshoring investment in 2024, with U.S. companies seeking to reduce container shipping times and geopolitical risk. India positioned itself as the long-term alternative, offering massive market potential alongside manufacturing capacity. Even countries like Thailand, Indonesia, and Bangladesh are capturing manufacturing share that would have automatically flowed to China a decade ago. Here's where the macroeconomic chess game becomes visible. During the first half of 2025, U.S. imports from China dropped nearly 17% compared to the same period in 2024, according to customs data analyzed by Z2 Data. That's not a statistical blip. That's a structural shift in the world's most important bilateral trade relationship. Over the past decade, sourcing from China, Hong Kong, and Korea has collapsed from 90% of supplier volume to just 50%. cutting China's manufacturing dominance in half. The December 2024 data from the European Union Chamber of Commerce in China showed that supply chain diversification had moved from talks to action. China's trade surplus did reach a record $1 trillion in the first 11 months of 2025. But here's the critical detail everyone's missing. That surplus was driven almost entirely by non-US markets. China's exports to the United States fell from 14.6% of total export value in 2024 to just 11.5% in the first 8 months of 2025. The Chinese manufacturing machine is losing access to its highest value customer. The financial architecture supporting this exodus is equally revealing. Companies aren't just moving factories, they're restructuring entire corporate entities to reduce China exposure. What started as China Plus One strategies in 2018, maintaining China operations while adding alternative sites, has evolved into China exit strategies by 2024. The Bain survey data shows that concerns over economic decoupling contributed to a 25% rise in companies seeking to reduce China dependence. That's not risk management, that's risk elimination. China's response has been defensive rather than corrective. The government announced its action plan to stabilize foreign investment in 2025, promising opening up of healthcare and telecommunications sectors. But foreign businesses know the difference between policy promises and operational reality. The restrictive business environment, arbitrary regulatory enforcement, and geopolitical tensions have created what investors call the China discount, the extra risk premium demanded for operating in an increasingly unpredictable environment. The macroeconomic implications cascade outward in 3 distinct waves. First comes the immediate dislocation. Factories close, workers lose jobs, and local governments that built entire revenue models around manufacturing tax bases watch their finances collapse. China's northeastern provinces, once the industrial heartland, are now experiencing what economists call economic voids, with severe demographic and economic unraveling according to December 2024 reports. When the factory leaves, everything connected to it dies. The restaurants feeding workers, the housing accommodating them, the services supporting them. The second wave hits China's strategic ambitions, the Made in China 2025 initiative aimed to make China dominant in 10 strategic sectors, including artificial intelligence, semiconductors, aerospace, and electric vehicles. The Chinese government invested over $150 billion by 2024 pursuing these goals. Yet, as foreign capital and foreign expertise exit, China's technological advancement stalls. You can subsidize domestic champions, but you can't subsidize away the loss of international collaboration, cutting-edge equipment access, and the competitive pressure that drives real innovation. The third wave reshapes global power dynamics. Manufacturing capacity isn't just economic, it's strategic. The country that makes the world's goods influences the world's politics. As manufacturing disperses from China to Vietnam, India, Mexico, and beyond, global economic power fragments. We are not moving from Chinese dominance to American dominance. We are moving toward regional manufacturing blocks where proximity, political alignment, and specialized capabilities determine who makes what for whom. Here's where precious metals investors need to pay attention. China has been the world's factory for silver-intensive manufacturing. Solar panels, electronics, industrial equipment, and electric vehicles. As manufacturing exits China, the silver supply chains that feed these industries are being disrupted. The entire commodity flow that assumed Chinese manufacturing dominance, where silver is shipped to China for fabrication into finished goods, is being rerouted. Silver demand patterns will shift, pricing mechanisms will evolve, and the financial instruments tied to these physical flows will misprice risk for years before adapting. The financial markets haven't priced this correctly yet. Stock valuations for multinational manufacturers still assume stable Chinese operations. Bond markets haven't fully accounted for the refinancing risk of Chinese industrial debt. Currency markets are underestimating the long-term weakness in the yuan as capital outflows persist. The $168 billion exodus in 2024 was just the beginning. If 69% of companies are actively moving out, we're looking at multi-year capital flight that could exceed $200 billion annually through the late 2020s. Consider the historical parallel. When U.S. manufacturing declined from the 1980s through the 2000s, the dislocation created the Rust Belt, political upheaval, and social costs that America still hasn't fully resolved. China faces that same transition, except compressed into a shorter time frame and at a much larger absolute scale. China's manufacturing sector still employs hundreds of millions of workers. Where do they go when the factories leave? What happens to a political system built on delivering economic growth when the engine of that growth is being dismantled? Here's the insight that separates observers from strategists. This exodus isn't about China failing. It's about the factory model itself evolving beyond what any single country can dominate. The forces driving capital out of China, automation reducing labor cost advantages, geopolitical fragmentation demanding regional supply chains, climate policies requiring localized production, these forces don't stop at China's borders. They're global structural shifts that will reshape manufacturing everywhere. Vietnam and Mexico are celebrating their factory gains now, but they're inheriting a manufacturing model that's already obsolete. The low-cost labor advantage that built China will be automated away in the next decade. The supply chain complexity that made China indispensable is being simplified by AI-driven logistics and regional production networks. The next manufacturing superpower won't win by being the cheapest. It'll win by being the most adaptable, the most automated, and the most politically stable. For those tracking global financial markets and the deep currents of economic power, the message is clear. We are witnessing the end of the China manufacturing miracle, and the beginning of something we don't yet have a name for. The $168 billion that left in 2024 was the capital that could see the future first. The remaining capital still in China is like the last guests at a party who, having tea, realized the host has already gone to bed. The smart money isn't debating whether to stay or go. It is already calculating the second-order effects in the countries receiving this capital flood. The systemic warning is simple. Every economic model that assumes Chinese manufacturing dominance is built on a foundation that's cracking beneath it. Supply chain logistics, commodity demand forecasts, currency relationships, geopolitical power projections, all of these mental maps are being redrawn in real time. The question isn't whether this transformation will happen. The data from 2024 and early 2025 confirms it's already underway. The question is whether you are repositioned for the world that is coming, or still invested in the world that ain't disappearing. The 200 billion factory exodus isn't a headline. It's a structural shift that will define the 2030s the same way China's manufacturing rise defined the 2000s. History doesn't repeat, but it does rhyme. And right now it's rhyming with the sound of factory gates closing, capital flowing across borders, and the slow, inevitable turning of the economic cycle that no tariff, no policy, and no government can ultimately stop. The only question that matters is this: are you watching it happen, or are you ahead of it?